Hello and welcome to this edition of TMA's Farm Margin Talk. This is Devin Schierling, Grain Marketing Manager for TMA. So as we look at our farm margin for March the 23rd, 2012, once again you'll see that there's good profitability available for both the 2012 and 2013 crop year. But what I want to focus a little bit on today is the changes that we've seen. So for example, corn last week had an 18-cent negative move on the week, which doesn't seem like a lot when you look at some of the market moves we had up and down in an individual day. But when it comes back to profitability, we're looking at a $34 an acre drop in irrigated corn profitability from last Friday. So the point is not that we're going to continue to drop lower or that we're going to go exponentially higher, but have a goal in mind to lock in that margin, and better yet, if this margin isn't what you're worried about, lock in a minimum margin using some of TMA's risk management contracts to help put you at ease at making a decision today. Beans week on week had a relatively no change. They were a little bit lower on the 12 profitability and then a little bit higher on 13, but overall very little change. And then wheat also struggled to maintain some of its strength this week. Once again, this is just the graphs that show you the micro details of how we come up with our numbers based on new crop cash prices at Groveland, Kansas. And this is just putting those same numbers into bushels per acre to give you a little bit of a different feel on what these profit numbers mean to you. And as you can see on, for example, on dryland wheat, with this decrease in our in the price that we saw in profitability, it only leaves us 2 bushels to be able to sell, which would equate to where our profit levels are at today. So we've been talking a lot about corn and a lot about wheat the last couple farm margin reports, but today we're going to talk about beans and the opportunities that we have today. So what this chart is a seasonal chart that goes back to the second quarter of 2005 all the way today and shows you the value of the upfront months. The point of this is these blue lines are the harvest delivery months. So the big blue rectangles, where my pointer's at right now, shows you what the harvest futures prices are. What I want to point your attention to is the 2008 and 2011 crop years. As you see, the yellow line shows you at 1363 where we're at today. So we've only had the chance at futures prices at these levels 2 out of the last really 6 years. So my point is not to tell you that the markets are always going to go lower. As you can see, you had the 08 year here, and then come harvest time, we knew what the crop we were going to have, and the prices fell the same way in 2011. But the point is you have an opportunity in front of you today at extremely profitable levels. And so if what we need to do is take advantage of these levels and also protect the ability to capture any gains in the market. So what can I do? 3 contracts that producers have been using a lot. One is TMA's Rally Catcher contract that allows you to put a floor in the market and then have unlimited upside. And as the market moves up, you have the ability to ratchet that floor up. It's an easy contract, and it really allows you to capture big moves in the marketplace. And then your normal minimum price or call spread contracts. Great contracts that allow you to get a guaranteed minimum cash price for your crop and then have upside, which is the name of the game. If the only reason why you're selling today is that you're afraid that the market may go higher or that you may not have enough grain to fulfill your contracts. This is the view that most people, if you looked out your window the last couple of days, would see of producers within the entire state of Kansas. Just jubilation of all the rain that we received. But it gets us to our next point is we always talk about managing that revenue, not just when you sign up for crop insurance or you make a sale, but throughout the year. Because the potential we have today, it should be $100 bills versus $1 bills growing out there in that wheat crop. And we need to do everything we can to maximize that potential. So really what I mean is that growing revenue potential that you have in your field. So with a relatively small investment of 4.6 bushels per acre at today's cash prices, you can put a fungicide product out on your plant that improves the plant health, and on average, it'll increase your yield 6 to 8 bushels per acre. And you're asking me, well, why are we talking about this? Well, everything that you can do to improve your farm's APH, which is actual production history, your APH is your currency on your farm. So you need to do everything you can to maximize what you have And kind of the reason why is on wheat this year, for every 2 bushels an acre of increase in APH, you improve your revenue guarantee by $13.7 per acre. A huge, it's a huge reward for a very small investment. So weather markets continue to be key for us going forward. So for those of you who are concerned about potential wheat freeze, we've been purchasing a lot of out-of-the-money call options, $8, $8.20 call options for a relatively small investments under 15 cents a bushel to protect from a runaway market wheat freeze environment. And then lastly, what's causing this market to move? Growing conditions, whether it be early corn planting, increased moisture throughout the wheat belt, or issues throughout the world. That's going to be huge going forward into the planting intentions report that comes out next week. And then also, how does world demand play into this whole picture? For more information on how you bring this farm margin talk to your farm, feel free to contact one of our grain marketing or crop insurance specialists. Thank you and have a great weekend.